Hey guys, what's up? I'm Erin and welcome back to the channel. Summer usually ushers in with it a sense of calm in the stock market, but that's not what's seeming to happen in 2025. Political shifts, economic uncertainty, and an unexpected rebound in one corner of the market have analysts paying close attention. I'm breaking down what's happening, what's driving volatility, and why some investors are keeping a close eye on small cap stocks right now. Just to be clear, this is not investment advice. I am never here to tell anyone what to buy or what to sell, but I do think it's important to understand the forces at play when they influence your portfolio, your retirement planning, or your just overall financial confidence. Let's start with the big picture. In April, the S&P 500 dropped more than 12%, following a sweeping trade policy announcement from President Trump, including a 10% general tariff and country-specific levies. It was the largest two-day market decline since 2020. Markets have since recovered much of their losses, and as of this recording, the S&P 500 is down about only 1% year to date. But that doesn't mean that investors are breathing easy. There are four primary forces that are continuing to spur volatility in the markets. Trade policy turbulence. New tariffs have introduced uncertainty in some industries, and as we know, uncertainty is the enemy of stable markets. Corporate margin pressure. Despite seeing a 13% earnings boost in Q1, many companies are still absorbing some of the price increases rather than passing them off to consumers, and this is squeezing profit margins. Federal Reserve policy. Interest rates remain elevated, Treasury yields are on the rise, and this means all eyes are on the Federal Reserve and what they will do next. And finally, investor sentiment. There's a growing shift towards global diversification as investors are hedging against domestic political and fiscal uncertainty. Summer typically brings lower trading volume and quieter markets, but not this year, so far. We are coming off a very highly charged political election year of 2024, and it is still having ripple effects throughout the economy. We're having a lot of fiscal policy changes, we're having trade policy changes, as well as regulation changes, and all of this is making the market unusually reactive. Inflation metrics remain unpredictable. Bond yields are climbing, corporate earnings have been strong in some sectors and then weak in others, and on top of that, many investors are holding more cash on the sidelines, just waiting for more clarity. So this isn't just seasonal noise. We still have tensions in our political environment. We have economic inflection points coming to a head, and we still have global uncertainty. So we're having an unusually noisy time in a time where otherwise the markets do tend to experience calm. And here's where it gets interesting. While large cap stocks have been bouncing around and tending to make headlines, small cap stocks have quietly been rebounding, up 20% from their lows of this year, according to the S&P SmallCap 600 index. And while it is still down for the year, what's driving its movements? First, there's optimism around potential economic stimulus, including proposals for extended tax cuts, deregulation, and increased infrastructure spending. One of the biggest developments in the proposed tax bill is the increase in standard deduction and the increase in child tax credit. This aims to put money directly back in the consumer's pocket, even if it is just short term and even if it is just temporary. And most importantly, whether you agree with it politically or not, this bill strongly favors businesses. And here's why that matters. When tax policy leads to a boost in business profits, when margins were already fairly slim, that leads to an increase in stock price. And when the markets do well, investors do well. So no matter where you are on your financial journey, this is a great reminder that you don't have to try and predict policy, but you can position yourself to take advantage of it when the market reacts to it. Second, we're seeing attractive valuations. And this is where PE ratios come into play. Right now, the S&P SmallCap 600 is trading at under 16 times 2025 earnings, while the S&P 500 is sitting over 22 times earnings. That's a meaningful gap, but here's what it actually means in dollars. Let's say both indices are projected to earn $10 per share next year. If the S&P 500 trades at 22 times earnings, that means investors are paying $220 for every $10 of earnings. If the Small-Cap 600 trades at 16 times earnings, they're paying $160 for the same $10 of earnings. So same earnings, very different price tag. And if you think earnings are going to increase over time, buying at a lower multiple gives you more potential upside. You get more earnings power for every dollar invested. Of course, lower valuations can also reflect greater risk or lower investor confidence. But for some long-term investors, the discount on small caps is worth a second look when we have strong projected earnings growth. Third, small cap companies tend to be more sensitive to interest rates. Many rely on floating rate debt, which means their borrowing costs tend to rise and fall based directly on the Fed's decisions. If we see the Fed pause hikes or even start cutting rates, those lower borrowing costs could free up cash for hiring, expansion, or innovation. And since small cap companies tend to be more domestically focused, they tend to feel these boosts more directly and more immediately. And finally, we're seeing strong earnings growth projections. Some analysts, including those cited in Barron's, are forecasting a 20% increase in earnings per share for the S&P SmallCap 600 by 2026. This is based on stronger margins, more favorable tax treatment, and strong demand here in the US. Now, could they be wrong? Of course. A forecast is just a prediction based on the most recent information available. It is not to be taken as gospel. But for long-term investors, this could represent a meaningful opportunity worth understanding. Let's take this idea and make it concrete with some real-world examples. VTSAX and VIOO. VTSAX is Vanguard's total stock market index fund. It gives you exposure to over 3,500 US companies, from mega caps like Apple and Microsoft down to the smaller firms. It is broad and it is well diversified, and small cap stocks are only a small fraction of that, about 6 to 7% of the total fund. VIOO, on the other hand, is hyper-focused. It tracks the S&P SmallCap 600, meaning it holds only small-cap stocks. You won't find an Amazon or an Apple in this fund. Instead, you'll see companies like SPX Technologies, Mr. Cooper Group, and Teleflex, aka smaller companies you've likely never heard of, more tied to US market conditions and more responsive to interest rate changes and policy changes. And here's a common misconception I want to address. If you're invested in something like VOO, Vanguard's S&P 500 ETF, you're not getting any small cap exposure at all. VOO only includes large cap stocks. It is stable, it is predictable, it is the 500 largest companies in the US, but it is not the entire market. This is a really important distinction to make because many investors feel like when they're invested in VOO or some fund that tracks the S&P 500 that they're invested in the entire market, and that is simply not the case. They're invested in large cap stocks only without any exposure to these smaller companies, which could represent an opportunity. Now, small cap stocks do come with more volatility. Think of large cap funds like a big, stable cruise ship. It's steady, but slow to pivot. Small cap funds are like a smaller sailboat, a little shakier, but they can catch the wind and accelerate fast in the right conditions. Now, that doesn't mean move everything to small cap stocks. Absolutely not. But what it does mean is that if you want to have a well-diversified portfolio and if you want to take advantage of having exposure to all different segments of the market, you might want to make sure that you're including all segments of the market within your portfolio. That way, when some of these segments do outperform others, you get to capture that upside. Here's my takeaway. You may already own small caps indirectly. Maybe you have the total stock market fund or a target date fund, but if you're solely in an S&P tracking fund like VOO, you likely don't have any exposure at all to small caps. You want to make sure you know exactly what your holdings are, because building wealth isn't about jumping on the latest headline. It is about being intentional in building a portfolio that fits your goals. With investing, you're always going to hear a lot of noise, but it is not your job to chase a headline. What you want to do is understand your portfolio, understand how you're invested, know your risk tolerance, know your goals that you're going after, and you want to be investing with intention, not reacting with emotion. Smart investing is rarely about making some sort of quick reaction to anything in the market. What you want to do is build something that is solid and lasts the test of time and grows with you over time. So what are your thoughts on having some exposure to small cap stocks? Leave them in the comment down below. I post new videos every single week. If you got anything at all out of this one, please give it a like. If you're new here, please consider subscribing, or if you know of someone who might get something out of this type of content, please consider sharing. I'll see you soon. Bye. Forces that continue to fucking train. This is the worst day of my life. Actually, no. This is a bad day. The worst day of my life was last week, so I thought I moved away from the airport. Does anybody remember Rhode Island and the airport every 4 seconds? Yeah. Well, now I live next to O'Hare, so. I'm dying today. That plane doesn't move. Memory card went blank. I've already done this video 3 times. Then my battery died. I have 3 of them. All 3 have died. Then I recorded the video again, forgot to plug my microphone in, and now here we are. And there's a plane circling. Oh my God. I hate my life right now.